Hi and welcome to Penser Bank and our interview with Fingerprints CEO Christian Fredriksson. My name is Markus Almerud and I'm an analyst here at the bank. Hi, Christian.
Hi, Markus, and great to be here with you.
Yeah, thank you for taking the time to speak with us. So you published your Q2 numbers yesterday, and some questions. If we start with the revenues. They were down 33% organically year-on-year and 28% sequentially. If you can talk a little bit about this, explain the drivers and particularly how important mobile was in this.
Yes, okay. So this was basically mobile. This was all about the mobile and the lockdowns in China. So mobile capacitive sensors, which was here. You can see, of course, our dependence to the Chinese market. And the Chinese market was down in the first 5 months of this year, 27%. And that, of course, leads to almost a break because they have, of course, the OEMs and the whole ecosystem has been hit the same way at the same time. And the ecosystem and our customers and many of the suppliers have built inventory for a different, of course, number than what happens when the lockdowns came as strongly as they came. So then what you end up with is just inventory depletion for the whole ecosystem, basically. So this was entirely based on hitting the mobile and entirely because of the lockdowns in China.
And if I get you right, then with the inventories, the inventory depletion basically means that your revenue falls more than the mobile phone sales.
Exactly. That's exactly what it means because, of course, we need to adjust to a basically different environment. And then, of course, you have inventories that have been built up for a different revenue across the whole ecosystem. And then it just stops. And that's what we have experienced now, which is quite brutal, actually, if you look at it from a business terms.
Mm-hmm. But if you look and you published some mobile phone shipment figures in the report yesterday, and it looked like the growth inflected in March or maybe in April, but in March I think it was, and we saw an improvement in April and in May in terms of growth rates. What are your impressions about June and the first weeks of July? Have this trend continued?
Well, actually, I think that from March, April, and May were very rough months. They were very tough, and but then in June, as the lockdown ended in kind of mid-June, roughly, right? So it was an extremely long lockdown, right? I think 75 days. Some of our people were actually closed in quarantine for 75 days, right? And basically, then we could see in June, we could see that inventory started depleting more, and the same has continued in July. So now there is clearly the inventories across the ecosystem and the chain are depleting. So I think a lot now depends on, and we hope that the worst is over. But it of course depends on how the COVID restrictions are moving around in China.
Mm-hmm. But with that caveat, so I mean, we don't know what the future lockdowns is if they're going to happen, what's going to happen with all that. But as you stand now, and with that caveat, it's fair to say that the trough should be behind you. It's not going to be worse.
Yeah, I hope so. Yes, exactly that. I mean, we can see right now that the inventories are depleting. When we say that this is temporary, what I mean with it is that we don't see that the zero COVID restrictions are going away in China. So you will see these waves of restrictions happening in different cities, in different areas, but we don't expect a nationwide shut down everything again in the same way as it happened in Q2. So it won't bounce back to the same levels as it was last year. But of course, it's very different from being, total hitting the wall situation. So right now we see improvement and we see the depletion happening. That's what we hope that continues now. And then you will get to a more normal situation again.
Mm-hmm. All right, let's change track a little bit. Maybe some positives, because there were some positives in the mobile market as well. For instance, you got your first design win for optical sensors in Q2. Can you talk a little bit about how important this is? And we know that you have a target to take 20% of the under-display market over time. Given that this launch is successful, how fast would you expect to move towards that target in terms of optical sensors?
Well, I think it will take, of course, a little bit of time, a couple years at least, right, for us to do that. We got to get into different customers and different models, and you got to work yourself in. I am very pleased, of course, that we got to this situation, because now, I mean, the optical market is, you roughly can say that there was the total market for mobile capacity was last year 600 million units, and 300 million units was optical. And then the ASP, average selling price, is higher for the optical market under display solutions. And that means that from a value perspective, revenue perspective, these are fairly, close to each other. So that means that we basically have doubled our market opportunity for us just with this move to get into the under display market. And we will see our first revenues now in Q4. And we expect to get more wins with new customers as well still this year in the under display market. So I think this is a fantastic thing for us, and helps us, of course, in this situation to expand into new technology and the same size of market as value as we are in now.
Mm-hmm. I think you mentioned in the report that there will be contribution from next year to revenues from this. So will they be visible? I mean, will they
Yes.
be not big enough to be visible?
Yes, absolutely, and we will already see the first rollouts of our products in Q4 now.
If we move on to the other segments where there was a bit more light, I mean, PC and Access, they compensated for what happened in mobile. What kind of growth rates are we seeing here? And maybe start there.
Yeah, well, I think it's I would say we haven't given the percentages, but it's strong growth, and it will continue, and it has continued. We have gotten into four in the PC area. We have gotten into 4 of the 6 largest OEMs, PC manufacturers in the world, and the penetration rate for fingerprint sensors in PC is growing, and there's a lot we can innovate in that space. So absolutely, it will grow strongly, both PC and Access, and I think that's why we see that if we had our business area, our areas outside of mobile capacity has been about 10% for the past 2 years. And now this year we expect to have about 25% of business outside of mobile capacity. And next year it will be clearly more than that even. So it is clearly this trend is happening for us now with PC and then of course mobile optical coming in. So it will be a much better diversification of our business.
And is it mainly PC driving this, or is it both?
Both. PC is of course PC has been smaller, but it's growing faster than Access, and it will surpass Access for sure as well.
And just to be clear, this is happening despite. I mean, we all read about the PC shipments being down, and Gartner and others are expecting them to fall this year, and this is happening despite that.
Yes. I mean, it's probably a 9%. That's what the prediction is forecast for this year, right? Roughly 9% reduction in the PC shipments globally versus last year, but the penetration rate for fingerprint sensors is below 20%, and it is over 80%, right, in the mobile phone area. So we expect good growth in terms of fingerprint sensor penetration within the PC, despite that there is a decline in the global volume.
And in payments, I mean, we see good growth rates here as well, but it's from much lower levels. How would you, or I mean, how would you expect revenues to be picked up here? Maybe just some color on what's happening in this space, and when would you expect for payments to give a real contribution to revenues?
I think that we will. It's always easy. What is a real contribution? We will see. The sales increase is very, very good. Which is obviously easy when you're going from such a low numbers, right? So, and it will continue also next year very clearly with the banks launching, more banks coming on board. We haven't given the numbers out of the payments because we are cautious, because it is not us who are launching, it is not us who are pushing it, it is the banks. And what I can say is that if you ask about generally what's happening in payments, is that we have launched now with 8 banks, and we see a handful of banks launching still this year. There is tens of banks in the process of going through and looking at launching in different ways, which we will see during next year. And when I look at this, what we see also is, if I look at the consumer and the ecosystem, so that is the banks. So the interest is rising. If I look at the consumer, in all the cases where the banks have launched, there is exceptionally positive feedback on the product. It works every time. There are no physical breakdowns. There is nothing not working. The sensor is working very well. I'm very pleased with that. There are no products returned to the banks, which is pretty amazing, right? So there's a lot of positivity in the consumers. The banks have still launched with the high end. The whole ecosystem is gearing up for this one. So all the production capabilities, all the big players from Thales, from Infineon to STMicron to LinkSense and G&D and so forth, all the big players are doing this. They're investing in it and putting effort and working from the manufacturing to the product definitions and so forth. So I think that all that is gearing up towards getting bigger numbers every year as we go ahead. That's what we see. So I think that's kind of the way we try to look at it, and then of course we push as much as we can and make sure that the products work. And there are 2 things that need to happen that we are working on right now. One is to make the enrollment easier. We want the banks to have a home enrollment and not go to the branch, and that is important. And there are a few good ways to do the home enrollment. And the other one is, of course, that we continue driving costs down for the card so that you can get the volumes easier up, right? I think that's probably what's happening right now.
Maybe we move down the P&L a bit and talk about profitability. So you had the gross margins, which was much better than it was in Q1. So up significantly, and actually, at least if I look back to 2018, it's the second highest that we've seen on record. So I guess they're benefiting for the positive product mix. Maybe talk a little bit about this and the drivers, etc., and what's behind this.
Yeah, and I think that this is what you're right. I mean, we had 31% gross margin in Q2 now, and Q1 we had 20.4. So it's of course huge shifts that we have on gross margin. And I mean, obviously one reason is that the mobile capacity basically went drastically down, and that is extremely competitive business and has been and continues to be so. So we have always it's difficult to get very high gross margins in that one. To get anything above 30% is not happening in general in that business. But the others businesses for us, which are now growing and we said are going to be 25% of our business this year, is better gross margins and better average selling prices in both all PC, access, and payment industry. That is the simple reason for this one. And I realize that it's a bit a roller coaster and tough for the market to follow that we have these swingers in the gross margin, because also within mobile capacitive and will be the same in mobile optical. You have a little bit different solutions. Some are for the low-end telephone, mobile phones going to Africa, for example, and so, and some are then for the more high-end. So there are products which are shifting around the phone. So you have different gross margins on those because there are different competitive situations on some of the products which are very low end versus the high end, which are more complex to manufacture and innovate around. So that means that we always, and we don't decide on the product mix because it's our customer based on how their market is growing, what products they are selling, and what is going more out. So that's why we have these big shifts actually also very easily in our gross margin. And I realize that's a bit nerve-wracking sometimes, right? But I think the trend now in quarters you can have shifts still, but the trend is of course for us that the more we get of the new business outside of mobile, and the better our gross margin is going to be.
And you've set a target, or I don't know if you want to call it target, but you mentioned 30% to get kind of a established 30% gross margin. I think you mentioned in the report somewhere. What's behind that assumption and what's needed for that to happen? And I mean, you're higher than that right now. You have been higher than 30% before as well.
Yeah, exactly. I think that what I said is that it should be possible to generate at least 30% gross margin in our industry in overall as a mix, and depending on a bit, and we're a volume player. We have high market shares, so that's what I believe that we should be doing. Now it's not always possible because of the product mix that we just discussed. I think that for us it means two things. For it to continue and for us to be able to get further up to 30%, it requires first that our mix of business is growing more outside of the mobile capacity as it is now, and it needs to continue. We need to innovate in those new areas. We have a lot to do in the PC area, for example, a lot to do in the access, a lot to do in the payment area. There's a lot of new innovation, and those are markets that are growing rapidly, where biometry is only coming in many of the segments in that space. And at the same time, in mobile, we need to continue to innovate in driving new performance and new cost structures into it so that we stay competitive and we can generate a fair gross margin in that highly competitive industry. Right? I think that's two things we have to continue to do.
Okay, because I also assume that, I mean, if I look at this quarter, it's just single out this quarter where the gross margin was over 30%, and also mobile sales was very low, and as it bounces, that'll be a headwind for the gross margin as well. So it's kind of that mix should still be sustainably over 30% is the right way to see it, because I mean it will be more difficult, of course, when mobile kind of bounces back.
Right? Exactly. You're correct, exactly correct. And when mobile bounces back, of course, we get much more volume. But of course, you're right that then, of course, it is less of gross margin business that comes in. So the mix changes downwards. So we need to continue both on the cost reduction programs and in terms of new platforms, new systems that we are bringing in every year. And on the same time, getting these new businesses to grow and take a bigger portion of our business, right? Mm-hmm. And that's what we need to continue to work on ourselves, right, all the time. Right? And then you have to remember that for us, we're a very scalable business, and this is, of course, was a drastic drop in revenues, and it's extremely painful to go through this. I have to say, for the whole organization, and I realize also for any shareholders, and I think that, but we are scalable upwards. So immediately when we get more volume and more sales, as of course our plan was for this year, which when we grew last year to grow this year, then of course our scalability kind of goes through the numbers easier. So you actually start making better numbers when you can do more volumes with the same amount of people that we have.
Mm-hmm. So if we look at the target finally, I mean, you had a target which was then taken away now, the 14 to 18% EBITDA margin in Q4 this year. This is still a reasonable level, even though the timing had changed.
Yeah, the timing has changed, but I think that's absolutely the levels that we want to get to. Obviously, we're not there now, and we have our, but we needed to get back to. That was also based on having, as I said, the scalability that comes through a little bit more sales, a little bit more revenue. So then the scalability shines through for us, and of course we have that. We're not going to give guidance now. We just took the guidance away because of the uncertainties in mobile, and but of course we should and we will. And it is clear that we have to aim to improve and continue improving the EBITDA margin towards those numbers, even if timing has shifted a bit here.
All right. So if I try to sum up a bit, I mean, you had a rough quarter, but we should also see this should all else equal be the trough for mobile in China, which means that these, I mean, we should see bounces going forward a little bit, and then there are some positives also in the mobile market with, you got the design win in optical sensors, which opens up a new market for you, and then you have PC and access, which is growing very strongly, and which also drives the gross margin. So that's kind of a rough quarter, but the worst should be behind you is a good summary.
Yes, we hope that on the mobile, right? As I said, I sincerely hope that the mobile depletion of inventory continues. It's totally up to how the lockdowns go on in China. And you're right that we have many, from our strategic work, nothing has changed really. We had to do a cost reduction program to safeguard the financials of the company. We did that swiftly as we believe in doing fast actions on these. But at the same time, when I look at it, I feel very optimistic about the PC access and payment business for us, and the diversification and on that is happening outside of mobile. And on top of that, as you said, from Q4 and going into next year, we will also have optical business, which is a huge market for us to get into. It took us a while. I'm very pleased that we're finally getting in there.
Well, with that, I think we will leave it there. So thank you very, very much again for coming and talk to us, and speak to you soon.
Thank you very much. Good being here, and speak to you soon as well.